Beware of the hidden fees. Here's what every entrepreneur needs to understand before taking a business loan. And we're going to talk about the 5 hidden costs of a business loan. And I want you guys, you gals, to take notes, rewind it back, because this is going to allow you to keep money in your pocket where it belongs so you can deploy it somewhere else, and wait for the end for the special bonus. And also, don't forget, if there's other videos you want me to do, add it into the comments. We'd love to be able to serve. How do business loans work? So remember, it is good if you're growing your company, and capital is very important, but don't just take a loan to take a loan. So there's some things I want you to think about when it comes to the responsibility of a loan. For example, a business loan is a loan taken out of a business to pay for business expenses, such as equipment purchases to cover operating expenses or to expand into new markets. Number 2, there are different types of business loans, each suitable for a different purpose and a different type of company. Number 3, business loans often have lower interest rates and are more generous repayment terms than personal loans. And number 4, almost any business can apply for a business loan, but a lender may require extensive documentation during the application process. And this is according to Investopedia, folks. So check this out. It's always important that you really understand what you're doing. Whenever you build a company or start a company, think of the end in mind at all times, but also in the middle and what you can and cannot do, and if you need permission or not permission from partners, or if you don't have partners. It's important you think about all this. There are hidden conditions. Understanding the fine print is especially essential when applying for a small business loan. You don't want to be surprised with any hidden fees that could increase the cost of borrowing. That's where it's always good to have a legal team with you. You want to make sure that they look over all your contracts, all your loans, everything that's tied to it, because some of these things could be negotiated out. Number 1 of the 5 hidden costs of a business loan is a prepayment penalty. If you pay back your loan in full early, you could be charged a prepayment penalty. But why would you be punished for being a responsible borrower? Because the lender loses out on making money off interest. Remember, there's always a schedule, a time frame on the payment back, monthly, yearly, however it may be, with an interest rate. And they may have this loan for 5, 7, and 10 years. And if you come in and pay it off in year 2 or 3, they lose out on that interest for the remainder of that loan. So there's always going to be a penalty, or there could be a penalty when it comes to that. You may want to understand what that is, how much that is, and if you could really recover the lost opportunity cost on that. It's important that you really I dot and T cross along the way. Number 2, guarantee fee. A guarantee fee is specific to an SBA loan, which is a specific type of small business financing backed with an up to 85% guarantee from the U.S. Small Business Administration. As a result, the SBA administers a fee to the borrower. That's essentially an origination fee charged at closing. Let me keep it real simple, folks. So if the SBA gives you a loan for $100,000, there's a fee that's based off of 85% or $85,000 of that loan, and they'll charge anywhere between 25 and 37 basis points. So they have protection in case somebody defaults on that loan. Number 3, owner control. When you open a business at the beginning, you just want money. So you may offer ownership in the company and the profit share, but there are risks to having even a 1% owner in your company, because if you want to make any strategy changes, they may have to sign off. This is why it's important to have clear operating agreements. Now, I can speak to this to my own situation, because I do have 1% owners as well as other owners, and there was a time when we went in to get a certain type of loan to make significant advances going forward, and we had to keep going back to the bank 3, 4, 5 times, and each and every owner, whether it was 1% or more, had to sign off, and it became something that was really a challenge from a time perspective and a fluidity perspective, and it wasn't clear in the operating agreement. But since then, we were able to make major adjustments and make sure going forward that we didn't have to put ourselves in that situation again. Our business did so well, we had no idea that we were going to have this beautiful gift of growth that we had, but then also with that, because in the beginning we didn't I dot and T cross, we found ourselves in a situation where things got a little bit slowed down because of the fact that we had to have a bunch of different people sign off on a bunch of different things. Number 4, closing costs. Often associated with real estate purchases, closing costs for small business loans cover other expenses involved with processing a loan, such as a business valuation or commercial real estate appraisal. If that's the case for your small business loan, be sure to look at the full details in the loan to know precisely what the closing costs are going to include. So remember, folks, at all times, you're using this money to really grow your business. Make sure you're responsible enough to handle what's about to come in if you're going to get the loan. But also, always ask your attorney or other people involved if, in fact, You can negotiate the closing costs. Any dollar you could save that's going to grow the business or keep money in your pocket is always a good thing. Number 5, factor rate. A factor rate is most often used to calculate the cost of a merchant cash advance, though it can also be used on short-term loans and invoice financing to figure out how much the merchant cash advance will cost you. Multiply the factor rate by the total amount borrowed. Let me go back to the cost of a merchant cash advance. If I'm going to borrow $50,000 and I need capital and I'm going to do a merchant cash advance, it's going to cost me a factor rate of about 1.4. So that means $50,000 times basically 1.4 is going to cost me 70. It's going to cost me $20,000 extra on top of the 50 for that loan. Those are heavy loans. Those are high interest loans, but sometimes people don't have the best credit, so they have to go for these kind of loans. Anyway, it's important to understand this whenever you're doing what you're doing, and you want to make sure that you I.T cross, because you can get yourself in a lot of trouble with these kind of loans if you don't have the speed and the business to pay them back in time. Thank you for checking out this video. And don't forget, we have a free gift. Please click the link below. One of the team members here at Epic is going to take you through our success process and do a free cash flow analysis, not only on your business, but on your personal. No obligation. Keep your checkbook in your pocket. Once again, thank you for being part of the community. And don't forget to like, share, and subscribe for more videos like this.